Value investing strategies are not for those investors looking to move quickly in and out of stocks on a daily or even an annual basis. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." When you invest in value companies, you must invest for the long term, and think in terms of years or at least months, not days or weeks. In fact, Buffett believes that all short-term price movements in the stock market should be disregarded by value investors, beyond using them as an indication of the best times to potentially pick up some new holdings. You should keep in mind that long-term investments are normally those that have lower risks. Rather than watching daily stock prices, you should spend that time keeping your eye on the operational performance of the companies in your portfolio. And rather than allowing market volatility to lead you into hasty and emotional investment decisions, you should continue to base your opinions of a company's value on facts. Sometimes it can take a company a long time to see its share price rise to match its intrinsic value. If you have the time, and if you won't need the money for many years, you have a huge advantage over investors with the opposite circumstances. You can buy, perhaps at a discount, when they need to sell. Good companies can trade at valuations that seem very low for years. This can happen when investors' attention is focused elsewhere, on hot tech stocks, for example, or when a sector is out of favor. Even if it takes several years to happen, the general principle holds. The market is usually efficient over the long run, and eventually, a stock's price will reflect the company's true value. If you've bought the stock at a discount, you'll make money, or a lot of money, if you sell it once its price rises to something closer to its intrinsic value. Having the patience to wait until that happens is one key to success as a value investor. So that's principle number 6. Make sure you have a long-term investment strategy in mind, and patience is key to your investment success. Okay, the final principle that you should keep in mind: know when to sell your stocks. Almost as difficult as knowing when to buy your stocks is figuring out when it's the right time to sell them. If a company is performing well, with no indication that its future growth potential has diminished in any way, then you can hold on to their stock until its market price exceeds its intrinsic value. Or in other words, you can hold your stocks until it becomes overvalued. Sometimes, however, stocks can become overvalued for the wrong reason, and this can be a warning that a severe crisis is in the works. The most common event that leads to a movement in stock prices is when companies release news about a new product line or management change. It can be good or bad news. If it's a positive reaction, the company's stock price will rise. If it's bad, the stock price goes down. Without question, the most important factor that affects a company's value, and therefore its stock price, is its earnings. Earnings are the profit a company makes, and in the long run, no company can survive without them. If a company's earnings are better than expected, its stock price increases. But if a company's results are worse than expected, its stock price will fall. Simple as that. Another factor is market volatility. Stock market volatility often leads to stock price declines across the board, even for companies with strong business fundamentals. Market downturns could be due to several reasons: changes in the economy, profit-taking after strong rallies, and geopolitical events. However, in such circumstances, stock prices may just decline temporarily, and chances are they'll recover in a few months. So you can take advantage of these scenarios to sell your stock at a high price and then buy it back at a lower price. It's a simple strategy for guaranteed profits. Another circumstance you should consider selling your stocks before everything gets worse is when the company suddenly cuts dividends without any acceptable reasons. As a value investor, we understand the importance of dividends, so you need to be wary when dividends are suddenly cut. 90% of the time, your stock price will plunge because investors no longer feel safe about their investments, and they're so concerned about the business performance. So, that's principle number 7. Know when to sell your stocks. In the next module, I'll teach you how to identify a company's economic moats so you can easily determine if a company has sustainable competitive advantages over its industry peers. Okay, see you in the next video.